Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sidus Space.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, I want you to imagine trying to read the license plate of a moving car, right?
Yeah, that sounds impossible.
Right, but imagine doing it while looking through a straw, traveling at like 17,000 miles per hour, 300 miles above the Earth.
Okay, wow. That is incredibly specific and frankly insane.
Exactly. And for decades, only massive billion-dollar government spy satellites could pull off anything even close to that level of precision. But today, in this deep dive, we're looking at a company trying to do it for a fraction of the cost.
Right, and we're looking at this strictly through the lens of a wealth-building opportunity for you. Because the mission of this deep dive is really to evaluate a company that's undergoing this massive fundamental strategic transition.
Yeah, they're attempting to pivot hard away from, traditional lower-margin hardware manufacturing and move into a highly scalable data-as-a-service model.
Which is huge. And some major technical milestones just hit in March 2026 that suggest we might be at a critical inflection point for their valuation.
But we also have to untangle some pretty severe financial realities to see if the upside is actually viable for your portfolio. So to understand the investment potential, you kind of have to look past the abstract romance of space exploration.
Oh, absolutely. You have to understand the brutal mechanics of what they're actually doing right now. They're in a pre-revenue scaling phase.
Which is notoriously dangerous, like a total valley of death for early-stage space infrastructure companies.
Exactly. And the engine of this whole operation is their LizzieSat constellation. It's a project backed by, what, $24 million in funding?
Yeah, $24 million. And it's designed to just fundamentally change how we process information from orbit. So what triggered our analysis today?
Well, it was an event on March 5, 2026. Their satellite, LizzieSat 3, successfully captured and transmitted sub-5-meter resolution on-orbit images.
And they used a non-Earth imaging camera from a partner for that, right? HEO USA.
Yeah, exactly. And, in the space infrastructure sector, the ultimate hurdle is just proving your technology actually functions in the incredibly harsh environment of orbit.
Right, because vacuum, massive temperature swings, radiation, it just destroys electronics.
It really does. So that March 5th milestone was the necessary technical validation. It proved their integrated multi-sensor chassis functions as designed.
Which effectively de-risks the core technology.
Exactly. It's step one on the path to commercial revenue.
Okay, let's unpack the mechanics of that achievement, though. Because sub-5-meter resolution, it isn't just a random metric they pulled out of a hat.
No, it's really not. When a satellite is moving at orbital velocity, keeping a camera perfectly stable to take a crisp photo of the ground is an absolute engineering nightmare.
Right. Like if you only have low resolution, say 20 or 30 meters, you're essentially just looking at colored blobs.
Yeah, you can tell if there's landmass or cloud cover, maybe a large body of water, but that's about it.
But at sub-5 meters, you cross a definitive commercial threshold.
Right. You transition from looking at a generic landscape to identifying specific infrastructure. You can actually monitor the movement of specific assets.
Like counting the number of shipping containers at a port.
Yes, exactly. Or tracking supply trucks moving in and out of a manufacturing facility.
Wow. And that level of granular, actionable data is exactly what defense contractors, agricultural conglomerates, and maritime shipping companies are willing to pay a premium to access.
Absolutely. By proving they can deliver that clarity, they've validated a highly competitive product for the intelligence market.
Which brings us to the core of this data-as-a-service pivot. I like to think about it like a major consumer tech giant.
Oh, like a smartphone company?
Exactly. A company might realize that manufacturing and selling smartphones is fine. It generates a chunk of revenue.
Sure, selling the physical device.
Right, but the real, massive, highly scalable wealth doesn't come from the one-time sale of the metal and glass.
It comes from the high-margin, monthly cloud storage and app subscriptions.
Yes, the stuff the user pays for every single month, indefinitely. And they're attempting that exact model, but in low Earth orbit.
They don't just want to build metal boxes anymore. They want to sell the monthly subscription to the data flowing through those boxes.
And the market for that data is expanding at just an aggressive pace. The numbers in the industry reports we reviewed are staggering.
Oh, they really are. The small satellite market is projected to grow at a 28% compound annual growth rate.
Wait, 28%? So what does that make the total addressable market?
We are looking at a total addressable market reaching $32 billion by 2030.
32 billion. That is massive.
Yeah, and that explosive growth isn't happening in a vacuum. It is the direct downstream result of plummeting launch costs.
Right, because aerospace companies have made it exponentially cheaper to send payloads into space.
Exactly.
Yeah.
Launching scalable multi-satellite constellations is suddenly economically viable for companies that aren't, backed by sovereign wealth funds.
But a rapidly growing total addressable market attracts intense, well-funded competition. Like, if the barrier to entry is lowering because launch costs are dropping, we have to look at how a company actually protects its territory.
Right, they need a moat. And based on the technical reports, their competitive moat is built on three distinct pillars.
Okay, what's the first one?
The first is the proprietary LizzieSat platform itself. It is modular and highly customizable.
Meaning it can integrate different sensor payloads from various partners?
Exactly, which is exactly what they did with the HEO USA camera. It acts like an orbital plug-and-play chassis.
That makes sense. And what's the second pillar?
The second pillar is where the technology separates itself from legacy systems. It's the integration of edge computing and artificial intelligence.
Right, I remember reading about that. In February 2026, they signed a memorandum of understanding with a company called Samara Sense.
Yeah, to advance AI-enabled hyperspectral imaging.
I want to stop and dig into both of those concepts because hyperspectral imaging and edge computing in space, they sound like science fiction.
They really do sound sci-fi, but they are the actual mechanics of the business model. So hyperspectral imaging means they aren't just taking a high-resolution photograph in the visible light spectrum.
Okay, so what are they doing?
They are actually reading the electromagnetic signature of objects on the ground.
Wait, really? Like, they can identify the chemical composition of a factory's exhaust plume?
Yes. Or they could determine the specific moisture and nutrient content of a cornfield from space.
Wow, that is incredible. But I imagine generating that kind of complex data creates a massive new problem with bandwidth.
Oh, absolutely. A hyperspectral image is a massive file. Traditionally, a satellite takes that heavy, raw data and has to hold on to it.
Until it flies directly over a designated ground station on Earth, right?
Exactly. Then it beams the raw data down, and massive computers on the ground finally process it to find the valuable insight.
Which creates hours of latency. And latency is just the absolute enemy of intelligence.
Which is exactly where the edge computing comes in.
Right. Think of the traditional method like a detective bagging up every single item in a suspect's house. The trash, the furniture, the dust.
Yeah, and shipping the whole house to a lab just to find one fingerprint, it takes forever.
Exactly. Edge computing means the detective brings a specialized fingerprint scanner right into the house, finds the print, and texts just the result to headquarters in 2 seconds.
I love that analogy. The AI processing happens right there on the satellite at the edge of the network.
So it analyzes the hyperspectral image in orbit, figures out what is actually important, and beams down just the immediate actionable insight.
Yes, it entirely bypasses the traditional ground station bandwidth constraints.
Which enables near real-time Earth observation.
And in the defense and intelligence sectors, the difference between knowing a fleet of vehicles moved 3 minutes ago versus knowing they moved 3 hours ago is huge.
Yeah. It's the difference between a successful operation and a complete failure.
Right. And that naturally leads us to the third pillar of their moat, which is their national security positioning.
Okay, let's get into this. They've been included as Golden Dome winners on the Pentagon's SHIELD vendor list.
Yeah, and in the defense sector, inclusion on that list is a massive signal. It suggests a gateway to incredibly sticky, high-margin government contracts.
Okay, I am going to push back hard on that defense angle, though. As an investor looking at the actual financials, my internal alarm bells go off when I hear vendor list.
Fair enough. Why is that?
Because being on a list, even a list with a cool, aggressive name like Golden Dome winners, is vastly different from having signed cash-generating contracts on the balance sheet.
That is very true.
Right. A vendor list is just a hunting license. So how should you, the investor, weigh the promise of speculative Pentagon revenue against the company's absolute burning need for actual near-term commercial cash flow?
You have to draw a hard line there. A hunting license guarantees absolutely nothing. It simply grants you access to bid on substantial U.S. defense contracts. Now, if you win them, yes, they are highly lucrative and notoriously sticky.
Because once the government integrates your proprietary data stream into their intelligence apparatus, they rarely spend the time and money to switch providers.
Exactly. However, the bureaucratic sales cycle at the Pentagon is agonizingly slow. It can take years from a successful bid to recognized revenue.
Years. Wow. So investors absolutely cannot rely on defense contracts to keep the lights on for the next 4 quarters.
No, they can't. The company must prove its data as a service model by securing private sector, commercial clients utilizing that sub-5-meter imagery.
Commercial traction is the necessary bridge they have to build to survive while waiting for those massive government gears to turn.
And survival requires cash. A $32 billion total addressable market is a beautiful concept, but building physical space infrastructure is a brutally expensive reality.
It really is. So we have to transition to the balance sheet. They have an ambitious roadmap to deploy a 100-satellite constellation.
The capital requirements for that are severe. Just to scale out the initial phases of this infrastructure, the filings show they require at least $24 million.
And realistically, much more as operations expand.
Absolutely. Which brings us to the most significant financial maneuver in the recent filings.
Right, the February 26th, 2026 filing.
Yes. The company filed a shelf registration to offer and sell up to $100 million in Class A common stock through an at-the-market, or ATM, offering.
Okay, understanding the exact mechanics of an ATM offering is critical if you are evaluating this as a wealth-building play.
It is, because it's very different from a standard offering.
Right. Usually when a company needs a massive amount of cash, they do a traditional secondary offering. They dump 20 million new shares onto the open market all at once.
And the order book instantly collapses under the weight of that new supply. The stock price craters by 30 or 40% overnight.
Exactly. But an ATM offering operates completely differently. I tell people to think of it like a massive, flexible credit line attached directly to the stock market.
That's a good way to look at it.
Instead of dumping shares all at once, the company hires a broker to slowly drip shares into the open market over time. They strategically sell on days when the trading volume is naturally high.
Right, which prevents a sudden catastrophic drop in the share price. And it provides a vital lifeline to prevent bankruptcy.
But let's be honest about the mechanics here. It is a slow, continuous, relentless drip of dilution for existing shareholders.
It is the defining tension of investing in early-stage infrastructure. That $100 million shelf registration creates an overhang.
Meaning every time the stock experiences a massive rally, management is kind of incentivized to turn on the ATM tap and sell shares into that strength to fund operations.
Yes, which effectively suppresses the price, capping the upward momentum for retail investors in the short term.
But if you connect this to the fundamental reality of their industry, it's basically a strictly necessary mechanism.
You simply cannot build and launch a 100-satellite constellation without raising massive amounts of external capital. The ATM structure is a risk mitigation tool.
It allows for measured, opportunistic capital raises, rather than desperate, highly destructive single financing events.
Exactly. But it remains one of 3 major existential risks you have to weigh.
Okay, so if dilution is the first risk, execution is the second.
Definitely. Space missions carry inherent catastrophic technical risks.
I mean, rockets are essentially controlled bombs. They fail, payloads get lost.
And satellites malfunction in the vacuum of space and just become million-dollar pieces of orbital debris.
The March 2026 success with LizzieSat 3 definitely mitigates some of this concern by proving the underlying technology works.
But every single future launch must demonstrate that same consistent, flawless reliability. One bad launch sequence can wipe out months of capital expenditure.
Wow. And what's the third major risk?
The third major risk is the pre-revenue business model transition itself.
Right. Pivoting from hardware to data as a service is a brilliant margin expansion strategy on a whiteboard.
But it requires actual paying customer adoption. They have built the infrastructure. Now they have to prove the demand exists at the price point they need.
And all of these risks culminate in extreme stock price volatility. I mean, if you look at the chart prior to the March rally, the stock was down nearly 31% year to date.
That is a massive, violent swing that requires a very specific, ironclad risk profile to stomach.
Which makes the recent market momentum so fascinating to dissect. Given the heavy capital dilution hanging over the stock, the inherent dangers of launching hardware into orbit, and the lack of current revenue, we have to look at why the market suddenly reacted so aggressively to the upside.
Right. The price action in mid-March was violent. On March 12, 2026, the stock jumped 11.06%.
And then a few days later, on March 17th, it jumped another 8.79%, hitting $2.23.
When you see consecutive double-digit percentage gains accompanied by heavy fundamental news flow, you're looking at a momentum breakout.
So this isn't just random algorithmic market noise.
No, the market was directly pricing in that on-orbit imagery success. The stock was emerging from a deeply depressed state, and the technical indicators suggest potential bottoming behavior.
Driven by institutional accumulation.
Exactly. Institutional investors wait for technological de-risking before they allocate capital. March 5th provided that de-risking.
But we really cannot ignore the macro element influencing this sector right now. The entire small-cap space industry was experiencing massive sympathy rallies.
Yeah, fueled almost entirely by the anticipation of a rumored SpaceX initial public offering.
Right. Retail investors desperately want exposure to the space economy. Since they can't buy SpaceX, they pour capital into publicly traded proxies.
A rising tide lifts all small-cap space equities.
So here's the trap for you if you are managing your own portfolio. How do you distinguish between a temporary sympathy pump driven by SpaceX rumors versus sustainable long-term growth rooted in their actual fundamental achievements?
You separate the signal from the noise by obsessively tracking the company's specific catalyst calendar over the next 3 to 6 months.
Because sympathy pumps fade the moment the news cycle moves on to the next shiny object.
Exactly. Fundamental growth requires idiosyncratic, company-specific milestones. The absolute most crucial catalyst on the horizon is the Q1 2026 earnings report.
Which is expected in late April or early May, right?
Yes, this is the moment of truth. This is where the narrative meets the spreadsheet. Management must demonstrate early revenue traction or signed commercial agreements stemming from that LizzieSat 3 validation.
Aside from the earnings print, what else needs to happen to prove the thesis?
You monitor the launch manifest. We need to watch for future, currently unannounced LizzieSat deployments.
Because every successful launch scales their data capacity and further de-risks the constellation model.
Precisely. Next, we monitor the progression of the SimmerAscent's hyperspectral imaging agreement. An MOU is a handshake. They need to move that to a definitive, actionable, funded contract.
And finally, any potential defense contract announcements related to the SHIELD program, right?
Yes. If those idiosyncratic catalysts hit, the growth profile is sustainable, regardless of whether SpaceX goes public tomorrow or 10 years from now.
So we've walked through the technology, the market size, the brutal capital requirements, and the upcoming catalysts. Let's bring this all together into a final verdict for you, the listener.
Weighing the fundamental technological milestones and the massive sector tailwinds heavily against the capital structure concerns, the dilution threat, and the pre-revenue risks, the final investment thesis awards this stock a bullish score of 7 out of 10.
A 7 out of 10. How should an investor actually categorize that in the context of a broader portfolio?
This is firmly categorized as a speculative growth position. You are looking at a target horizon of 12 to 24 months.
So not a quick flip.
No. And let's be unequivocally clear. This is strictly for investors with a high risk tolerance who are specifically seeking concentrated exposure to the emerging commercial space infrastructure sector.
It is an asymmetric upside opportunity.
Exactly. By transitioning from traditional hardware manufacturing to recurring data as a service revenue, they are positioning themselves at the exact intersection of edge computing, AI, and hyperspectral intelligence.
The March 2026 rally marks a potential inflection point.
Yeah.
But the burden of proofs is definitely on the company.
You must actively monitor those upcoming quarterly earnings for tangible metrics showing actual paying customer diversification.
We are entering an era where the orbital environment is becoming increasingly congested and highly contested. Every major nation, every defense department, and every massive global corporation wants eyes in the sky. So I want to leave you with one final thought to mull over as you look at your own wealth-building strategies. Over the next decade, will the ultimate wealth-building winners in the space sector be the highly publicized, incredibly capital-intensive companies launching the physical rockets? Or will the real scalable wealth be quietly accumulated by the under-the-radar companies who turn all that chaotic space traffic into an indispensable high-margin, subscription-based data monopoly? Think about it.